For decades, fixed income investing was built on predictability. You bought a bond, you collected a steady yield, and your principal was safe. But when interest rates rapidly returned to elevated levels, that foundation crumbled. Across the $30 trillion U.S. debt landscape, the standard defense mechanism suddenly became a liability. It's a mechanical issue called duration risk. When prevailing market interest rates go up, the capital value of existing, lower-yielding fixed-rate bonds drops. To address the exact vulnerability caused by rising rates, the Treasury Department introduced a completely new asset class in 2014, the floating rate note. Directly following those first auctions, WisdomTree engineered a direct mechanism to capture them, launching the Floating Rate Treasury Fund, ticker symbol USFR. Instead of fighting the destructive tide of rising rates by trying to guess the top of the market, this fund uses those exact rate hikes as an engine. It absorbs the volatility and floats the portfolio's yield right alongside it. Despite managing over $17.5 billion in net assets, the internal architecture of USFR relies on extreme minimalism. This diagram outlines the fund's specific holdings. It strips away thousands of diversified microallocations to hold precisely 4 distinct U.S. Treasury floating rate notes. These currently mature in April, July, and October of 2027 and January 2028. Compare that to the rigidity of older paper-based government debt. If you held a classic savings bond, your yield was locked. You were bound to the exact interest rate environment of the day you purchased it. These modern notes completely abandon that locked-in structure. The interest rate on these 4 specific assets actively floats. The fund's payout rates reset every week, pegged to the Treasury's 13-week T-bill auction. This reset acts as a real-time shock absorber. During extreme bond market volatility, USFR translates those rate hikes into immediate higher yield payments. This intense concentration into just 4 specific notes removes nearly all the variables. It isolates the capital, leaving the pure weekly trajectory of short-term interest rates as the sole driver of the fund. To allow that floating mechanism to perform, the ETF wrapper itself has to operate with almost zero friction. The fund carries a net expense ratio of 0.15%. Keeping that structural cost low is critical for a cash-equivalent vehicle, as heavy fees would immediately drag down the take-home yield. Then we look at the credit profile. The portfolio is 99.99% AA rated. Because the underlying assets are backed by the full faith and credit of the U.S. government, standard default risk is effectively removed from the equation. But the most vital defensive metric for any fixed income allocation is its effective duration. This gauge tracks USFR's effective duration, sitting squarely at 0.02. A number that close to zero makes the portfolio virtually immune to principal damage. While standard 10-year and 30-year treasuries swing violently, this near-zero duration keeps capital completely isolated. Yet, despite that heavy defensive posture, it maintains a highly competitive income stream, with SEC 30-day yields holding around 3.60%. The underlying metrics prove how the fund operates. It functions as low-friction armor, allowing investors to harvest yield from the market without exposing their principal to duration risk. The true utility of this specific architecture only becomes clear when you map it against current macroeconomic conditions. The primary tailwind driving ultra-short assets right now is an inverted yield curve. We are in an environment where investors are actually paid more to take on significantly less risk at the short end of the timeline. Portfolio managers actively exploit this anomaly. They use USFR as the passive cornerstone in a barbell strategy, safely parking their cash at high short-term rates while directing their risk-taking toward equities. But the exact mechanism that protects the fund on the way up creates reinvestment risk on the way down. Because the notes reset every 7 days, any rate cuts from the Federal Reserve instantly trigger a drop in the portfolio's yield. You get zero locked-in rate protection if the market suddenly shifts. USSR is not a permanent all-weather vault. It is a strictly tactical instrument that is entirely tethered to the prevailing winds of Federal Reserve monetary policy. So, how do you position your capital in a $30 trillion market that refuses to offer the safety it once did? The bull case for USFR is clear. It is an incredibly efficient, near-zero duration tool that captures rising yields without exposing you to credit or duration risk. The bear case is equally direct. It offers absolutely no defense against falling rates, and the moment a sustained cutting cycle begins, it will aggressively underperform longer duration bonds. Which side of the strategy makes more sense to you right now? Do you want an ultra-short, weekly resetting anchor for your cash, or are you looking to lock in long-term bonds before rates fall? Let me know in the comments. If you found this breakdown useful, hit the like button, subscribe, and stick around for more cinematic market analysis right here on Stocks Simplified. Remember, there are risks associated with investing, including the possible loss of principal. Securities with floating rates can be less sensitive to interest rate changes, but may decline in value. Always carefully read the prospectus containing investment objectives, risks, charges, and expenses before you invest.